Today's topic is simple. Vanguard, Schwab, and JPMorgan, they're all pointing to a different next decade. And that matters because a lot of retirement portfolios are still built like the last decade is going to repeat itself. This is not about panic and it's not about headlines. It's about upgrading diversification so your plan is less fragile. Two surprises are driving this conversation. Your equity 60 portfolio is far more concentrated than most people realize. And most retirees are also making a hidden US dollar bet even without realizing it. Before opinions, let's establish the facts. When independent research firms start agreeing, that's not noise, that's a signal. Vanguard sees lower expected US stock returns over the next decade, driven largely by concentrations in large capitalization technology stocks. Charles Schwab projects higher expected returns for developed international stocks, citing valuation advantages and potential US dollar weakness. And JPMorgan, in its long-term capital market assumptions, explicitly highlights currency as a return driver for international investing. This isn't just Vanguard or Schwab. Even JPMorgan's long-term assumptions, well, they're all pointing in the same direction. So what changed that make diversification harder and more important at the same time? The classic 60-40 portfolio isn't dead, but it was built for a different environment. For decades, falling inflation and falling interest rates help bonds act as a reliable shock absorber. But in inflationary or deficit-heavy regimes, stock and bond correlations, well, they can rise. That means bonds don't always cushion equity drawdowns the way people expect. And that is exactly where people get tempted to say, fine, I'll just go haul cash. But cash only is not a plan. Cash is stability, not a long-term strategy for purchasing power. The answer is upgrading the structure, but not abandoning it. And the bigger surprise is what the equity 60 has quietly become. The S&P 500 no longer behaves like 500 equal ideas. A small group of very large companies now dominate index behavior. Roughly 30% of the S&P 500 is concentrated in just 7 stocks. And the Magnificent Seven stocks have names that you already know, names like Apple, Microsoft, Nvidia, Amazon, Alphabet, Meta, and Tesla. These are extraordinary companies. This is not an attack on their businesses. It's an observation about portfolio behavior. Because index funds don't choose winners, they allocate according to size. The bigger these companies get, the more new investment dollars are automatically funneled into them. That creates what I call a feedback loop. Size attracts flows, and flows reinforce size. At a certain point, concentration reaches an event horizon. The point where money keeps flowing in simply because these names already dominate. That's not a judgment. It's mechanics. It's gravity. And it's why, in quotes, I own the S&P 500 can behave more like a concentrated bet than most people even realize. Fear of missing out, or FOMO, doesn't diversify risk. It concentrates it. So if bonds are less reliable shock absorbers and equities are narrower than they appear, what's the upgrade? This is where international investing comes back into the conversation. Not as a trade, but as risk management. International markets bring different sector weightings, different valuation regimes, and different economic drivers. They also reduce single market dependence, which matters when equity leadership narrows in the United States. But there's a second benefit people tend to ignore: currency. A US-only portfolio isn't just a stock bet. It's also a one currency bet because your wealth is priced in US dollars. And this is exactly the point that the big 3 research houses are making. If the US dollar weakens over time, foreign earnings and foreign assets can translate into more dollars for U.S. investors. You don't need to predict the dollar. You do need to manage the exposure. And here's the practical way to think about it. If you're retired, you don't spend index points. What you spend is purchasing power, such as travel, imported goods, energy. There's a long list of everyday costs that have global pricing components. So a weaker dollar doesn't need to create a crisis to matter. It just has to quietly raise the cost of life over time. Now, the dollar can strengthen too. Currency, well, it cuts both ways. That's why this point isn't to make an heroic bet. The point is to avoid being all in on one outcome. So the question becomes, how do you adjust without overcomplicating your life? Well, here's a clean mental model. Sit down, relax when I tell you this. Give your money jobs. Cash is time protection for near-term spending. Bonds are shock absorbers. Imperfect insurance, but still useful. Equities are for long-term purchasing power, and they need more than one engine. If your equity sleeve is mostly U.S. large cap, you're concentrated in one market story and one currency story at the same time. A practical upgrade is to make the equity 60 more global, not by guessing winners, but by spreading the engines. Now, I need to say what this is not. This is not a prediction that the United States is finished. This is not a call to dump U.S. stocks. And this is certainly not a promise that international will outperform every year. International can lag for long stretches, as we've seen recently. And currency, well, it cuts both ways. That's normal. The reason you hold diversification is not because they win every day. It's because they don't lose the same way at the same time. And if you're wondering about rebalancing, well, here's the simple principle. Rebalancing is not market timing, it's discipline. It's the act of trimming what grew and adding to what fell. So you don't end up accidentally all in on yesterday's winners. That matters more in a concentrated market because concentration tends to creep up on you without your permission. There is no risk-free portfolio, but there is a real distinction between a fragile one and a resilient one. One sector, one valuation, one story, one currency outcome. That's the upgrade. But my goal is not to be performative here today. My goal is to put question arrows into your quiver so you can ask good questions. This content is not educational. I'm not a financial advisor, and you should consult a qualified professional before making decisions. If you like this video, please take a look at two of my recent videos. Vanguard warned you the retirement danger zone the first 10 years. And Boomers, Vanguard cracked the door. The real sequence of return risk monster emerges. Thanks again for listening. I certainly appreciate it. And remember, health is wealth, and wealth is freedom.